Hey everybody, welcome back to the channel. Cathie Wood is fighting back. She is absolutely annoyed at everything that is going on in the market, and she is voicing her opinion about how annoyed she is. She is so annoyed that her ARK Innovation Fund was at $170 in February 2021, and now it's at $70. She is so annoyed that Teladoc, one of her largest holdings, was at $308, where she had 163 cost basis average. She was up pretty big. And now it's at almost $89. I mean, she is really annoyed at what's going on in the market. And as a result, you have to get your voice out there to get a counter narrative. When a narrative doesn't support what you believe it should be supported, and you've got quite literally billions of dollars on the line for the narrative to change, because the stock market is primarily run through the perceptions and narratives that people have on how they should understand the stock market, then you've got to release some propaganda. You've got to propagandize your thoughts. And I don't mean propaganda in a negative way. Propaganda is just different media that you're putting out into the world. Cathie Wood just did a recent webinar on her ARK Invest webinar YouTube channel thingy podcast. And she brought on a friend who, you know, it sounds a little sus, because it's like, hey, this is my friend that I've known for 40 years and she's an economist, blah, blah, and she's going to spit some fire on this podcast, but like, she's also your friend. But this lady is actually very knowledgeable. Her name is Nancy, and she's from this place called Cornerstone Macro. She's a macroeconomist, and she is getting a lot of hate in the economics community for her perspectives, but her perspectives align with Cathie's perspectives, and they have a lot of good reasons for why their perspectives align. So in this video, we're going to summarize what they said over the course of that podcast. I'll put the link in the description if you guys want to watch the real thing. But there you have some interesting stats to bring out for why what's going on right now is really, really interesting. So top level thesis before we get into the specific stuff, they think inflation truly is transitory. And again, this is the debate that has been going on. Is inflation transitory or not? Obviously, the Fed, which controls the flow and supply of how money enters the market, is wanting to raise rates. And when the Fed raises rates, it hurts growth tech companies, because growth tech companies have to pay more for the cost of borrowing money because the interest rates are higher for when you have to pay back that money, which means that investors take their money out of growth tech stocks and they put them into better stocks, either value stocks or 10-year bonds. This is why the 10-year bond is at all-time highs in the past 18 months at 1.8%, because it's a better return on your money and it's less risky. So at that point, interest rates definitely hurt the type of stocks that Cathie's invested in, because she's invested in all these growth high-tech companies, Teladoc, Roku, Palantir, etc., that don't really have a lot of profits now, that are just going to capture market share, and that don't really have like reliable earnings numbers that are really, you know, great for investors, but they are going to get them in the future. So investors have to be willing to pay a premium for the fact that they're going to grow exponentially and then get their money on the upside. That's not happening right now. And that's what's happening right now, is all of those stocks are getting decimated. So as a result of that, inflation and the Fed raising rates to combat inflation is only going to hurt those growth tech stocks. And because it's going to hurt those growth tech stocks, if you can win the argument, if you can win the narrative, if you can propagandize your views that inflation is indeed transitory, that people need to stop worrying about rising interest rates and like being so hawkish on what's going on in the market, then you have a better opportunity to change the narrative, change the perception, and potentially raise the stock price on these decimated stocks. So Nancy from Cornerstone Macro has a bunch of charts that we're about to get into right now, and a bunch of thoughts that believes that inflation is indeed transitory. And obviously there's going to be rate hikes. There's nothing stopping the Fed from raising interest rates, because it's healthy to raise interest rates. I did a podcast with Aisha Tariq, who's a corporate banker from Dubai, and you guys should watch that. I'll leave it in the description. She did a phenomenal analysis for why the Fed actually has to raise interest rates, so you can like know once and for all why it's important. Because I even asked her, I was like, do we really have to do this? And she was like, no, like we got to do this. However, it's to the question of how hawkish are you going to be? How much are you going to raise the interest rates, and how much is that going to affect growth stocks? So the first argument Nancy makes is that the community has too short of a time frame. So she's talking about from a macroeconomic perspective that her community, the people that she works with, they don't think in a long-term trajectory. And because they don't think in a long-term trajectory, they are only evaluating the short-term economics of what is happening on the day-to-day. And that is hurting their ability to actually evaluate the digitization that's going on, that we're going to talk about a little bit more, in the economy, and the innovation that's going on. Ultimately, this Nancy person concludes that innovation is here to stay, and she gives a lot of good examples for why innovation is here to stay, and that because inflation is not as big of a deal as we think it is, like yes, it is there, but it's not as big as we think it is, then that means inflation is going to start to go away as innovation increases as well. And there's some macroeconomic numbers for why inflation is going to start to decrease. So the first chart she presents is that consumer spending on goods went wild during the COVID pandemic. This was really March 2020 all the way until summer of 2021. She says that 3 years worth of goods were purchased in the past 18 months. So think about that. 36 months of all the goods that you need to purchase, whether they're laptops or this or that or headphones or microphones or shoes or whatever stuff you want to buy to stock up in your house, was purchased within the past 18 months. That's a big deal because when consumers are buying that much stuff, that's not healthy for an economy. Why is that not healthy for economy? Because you might think, oh, well, if consumers are buying more stuff, then companies are making more money. And if companies are making more money, then governments are collecting more tax revenue and everything's, kumbaya. No, when people are spending that much money, that means the supply of the things that exist is getting lower and lower if there's supply chain issues, which there are because of the COVID pandemic, which was the reason people started buying stuff because they were afraid they weren't going to be able to get enough stuff. So if you don't have enough supply and you have a lot of demand of people wanting to buy a lot of stuff, all that demand is going to take the basic principles of supply and demand to get the stuff you're trying to buy to go higher in terms of prices. If there's only 5 cupcakes and there's not any more cupcakes in the cupcake factory and there's 7,000 people that want one of those cupcakes, in fact, they want 3 of those cupcakes to stack up for the next 18 months, then the price of those cupcakes are going to get ridiculously higher. And that is what has led to inflation over the past 18 months. So she said that that's starting to go away. She is starting to see that there is a lot of weakness in these sectors in terms of consumer demand, and this is very consistent with Cathie's reports from the University of Michigan, which is one of the major, basically reporting centers that does these types of economic surveys, that is saying that consumer sentiment is either going down or flat, meaning people are not stocking up 17 laptops anymore, right? They don't want that many more cupcakes because they don't need that many more cupcakes because there's not really that much demand for any more cupcakes, right? It was when there was an economic crisis going on and people thought, the world was ending. But now that's not happening. As a result, prices were pushed up dramatically during that time, which led to inflation, and those prices are starting to go down. So if consumer demand is going down, those prices are going down. Now, in the context of supply, she's also saying that supply chain bottlenecks are over. She flat out said that there is not a supply chain crisis anymore. She said there was a crisis back in the summer of 2021, but ports have started to open up. The Omicron fears are not that intense, and the Delta fears, again, were intense in summer, which is why this was happening. But the Omicron fears are not that intense to the point where ports in, Los Angeles and Hong Kong are just going to close, because we've seen that the Omicron doesn't really kill people at that bad of a rate, right? And a lot of people are getting their booster shots. So it's like we're starting to see the end of the pandemic. Now, it's not happening right then and here, but reasonably one could predict by 2023, there is going to be a world in which COVID is not as big of a deal as it is anymore. And it might just go away. So if that's the case and ports and supply chains are reacting to that, then there's plenty of supply, which means there's not that much demand because you can go get that laptop tomorrow if you don't get it today. There's not this existential crisis of like, oh, I need to get a new laptop, which is why it's not hurting anything. So supply is increasing, demand is decreasing, which means prices are stabilizing, and inflation as a result is going down, i.e. being transitory because it's not as bad as it was before. She also is talking about the used car market. Now, this is a big deal for Cathie. Obviously, Cathie invested heavy in Tesla, and Cathie's sort of whole thesis around used cars is very important because this is what she believes is one of the leading indicators for why inflation is transitory. So she said that used cars prices soared, contributing to 33% of the CPI, which is the index that actually measures how consumers are how inflation is going up within consumers. So used car prices throughout the pandemic were going up. They were going up a lot. There's no denying that. And that contributed to 1/3 of the increase that we see in the CPI. Now, those prices have gone 11% down from their all-time highs. And she's saying 11% is conservative. So if 11% of these prices are going down, that means individuals or consumers don't really want to buy used cars anymore, or they're not massively overpaying for the used car market, which means it's not that big of a deal. So if it's still elevated and it's coming down, the inventories in the used car space is also 40% above normal now. And this is one of the stats that Cathie Wood put in while they were having this discussion. So if used car prices contributed to 33% of the increase in inflation because used car prices were super high and everyone needs a car, right? The car market and automotive market is a big sector of the economy. But now those prices are down 11% from their all-time highs, and they're going lower and lower because demand is shifting lower and supply is normalizing. And 40% of the inventory in the used car space is increasing, meaning if there were 10 cars, now there's 4 more cars, so there's 14 cars, which means there's 40% more inventory in the used car space. Then that should also lead to deflation. That should also lead to inflation ultimately being transitory because there's less of a price for a used car, less people need to buy a used car, and if they did want to buy a used car, there is a ton of inventory, which means there's not going to be this overpaying of a price for a used car because they don't need a used car because the prices are going down and the demand is going down and the supply is going up, which means if they did need it, it wouldn't be that expensive in the first place. Okay, final main point that they bring up is productivity is increasing and the entire world is digitizing. So this is the final thesis that they're making in this argument, which is that innovation is not going away. What happened in COVID was actually one of the most amazing things for the ARC Innovation Fund, because it showed that the entire world is starting to get disrupted, and they're going to start to use the digital technologies that Cathie is heavily invested in, because it's going to make their processes more efficient, more effective, and ultimately make those companies a boatload more money. So one example is Zoom. If you don't have to go in person for a meeting and get in an Uber and like find your colleague from across the town and then meet up to get lunch and then talk about stuff where nothing's really going to get done, but you can do a Zoom call super quickly through this amazing audio video platform and get the meeting done in 5 minutes, you're going to be more productive. And more companies have realized that, oh, if we just use these technologies, we make more money, which means we should probably integrate these technologies into the fabric of our organization, which means those technologies get more valuable. And that's why Cathie's making the bet on that. So digitization is increasing. One of the things that this Nancy person brings up as well that's super interesting is that Deere, which is a company that makes tractors for farmers, launched an autonomous tractor, and it's being used in different farms. So think about that. A farm is probably the least likely place you would think to digitize and modernize in the modern ecosystem, right? You think of Tesla, SpaceX, but then you think of a farm that's just getting crops. There are autonomous tractors that are saving time, money, and energy for farmers, actually help to build crops and get things done on a farm. So when you see that level of innovation happening, her argument is kind of like the entire macroeconomics don't understand what's going on. You can't just measure it through these small numbers that traditional economists use. You have to understand the relationship between supply and demand, and you have to understand that the pandemic, although it inflated prices because of the differences we saw with supply and demand, it also changed the paradigms by which people thought about digitization, technology, and modernizing their own enterprises. You have businesses modernizing, you have governments modernizing, you have restaurants modernizing, you have factories modernizing, and you have farms that are modernizing. So when farms are starting to modernize, that's when you know that technology is here to stay, that innovation is here to stay, and the entire macroeconomics are way too short-term focused, because this stuff is not going away. And that's the final thesis that they basically said, which is that if we look at the macroeconomy and prices are starting to go down because demand is starting to go down and supply is starting to go up, then that means over time, this inflation is simply not going to be as big of a deal as we think it is. And then if you factor into the rate hikes, that's also going to decrease inflation as well, which means throughout 2022, it might be over with, or going into 2023. Now, I don't know if that's going to happen. This is betting on this thesis being correct. But if it is correct, then that would be the case. And additionally, because of everything that happened in the past 24 months, innovation is not going away. And when we mean innovation, we mean companies modernizing into the digital era in terms of all these technologies that they're going to be able to use that aren't going to stop having value, because companies are not going back to how things used to get done. Which means if companies are not going back, innovation is here to stay, supply is going up, demand is going down, then inflation just might be transitory.